CNBC's exclusive Wealth in America report that we unveiled earlier this week revealed some rather surprising results. One question that came out of it: do the rich actually get better investment results than the rest of us? CNBC Steve Leisman here to join us with the axis of easel.
That's right. And a special report for all the Tevyas of this world, which are more than the other guys, and how to invest like a rich man. It turns out, I was very surprised by these results. They expect better returns. Do they actually get them? I don't want to give it away right now because we have some interesting research that we came across. Here's what our poll showed. The wealthy expect better returns. The percentage expect higher returns for those with salaries greater than $100,000 is north of 60%. You can see right there. Okay. While those with less than $30,000 and with something in the market, the percentage expecting higher returns is just around 40%. Those expecting a lot, 12%, just 5% for the poorer group. Let's take a look here now. Wealthy investors do actually have a higher return on their stocks. Yosef Bonaparte from the University of Texas, by the way, he's Israeli, that doesn't really mean anything, but that's what we're talking about. He did a very interesting paper which showed this, returns in 1998, just one example. This is the wealthiest investors, this is what they received. The poorest investors, the bottom quintile they call it, and this was the S&P. The poorest investors earn less than the market, the richest investors earn substantially more, and if you do it on a risk-adjusted basis, Bill, it actually looks like this. Just a little bit more, but the gap is actually higher. So they seem to be getting higher returns without taking on more risk, which is, to my mind, very interesting. We came across some reasons, both from Yosef Bonaparte's paper.
You're going to answer the question we all asked.
Try to answer the question, why is that?
Okay.
Both from his paper, and we talked to a bunch of investment managers today. Yosef Bonaparte found this: more productive research. They do, his data show they do more research and they do more productive research. They're more likely to consult a financial planner or otherwise use paid websites for information and do better research at the time. They also do more of it. By the way, I asked him if CNBC counts, and Yosef Bonaparte said yes.
Okay, good.
Watching CNBC is information is good to have.
Good.
You can't duplicate this if you don't have as much money, but they also pay lower fees because they have bigger pots.
Bigger volume,
They're
right.
not. Also, they have more managing selection. I wrote here, the alpha investor gets the alpha manager. Because some managers won't take on smaller clients. You have a broader selection, and in general, you have an opportunity to get better managers. But here's another thing that's interesting. More cushion, less forced selling. So on these scores here, when it comes to this one and this one, poorer investors or investors with less money can act like rich investors if, one, they do more research and spend their time looking it up more productively, and two, if they don't act with the crowd. There are many situations when there's panic selling where you can see from the volume and the numbers that it's the small investor who's selling out while the wealthy investor is standing pat. So you can't get the lower fees. You may not get the alpha managers, although there are some opportunities with that too. But these two right here, more productive research and more cushion, is how to invest like a rich man.
Bravo. And hopefully all the Tevyas out there are listening.
Yeah.
Very much. Steve Leisman, another great
You got to dance for us now?
No, I will not.
Okay.
At least not right now. Thank you. We're coming up in the half hour. We'll update the markets once again. Bob O'Brien will have the hour's stocks to watch. And we update the CNBC.com $1 Million Portfolio Challenge, including